I'm about to tell you something that will either offend you or set you free. When I walk into a professional services firm, I don't trust the numbers, not the timesheets, not the revenue reports, and not the margin calculations. And the founders who've been around long enough already know that I shouldn't. I'll explain to you why most of this data is unreliable. Not because you're bad at accounting, because professional services are actually really hard to measure. I'll show you what breaks the numbers, and I'll explain the forensic approach that gets you to something that you can actually trust. Everyone knows the phrase garbage in, garbage out, but almost nobody acts upon it. Your accounting system, your timesheets, and your project tools are only as good as the data going in. But in professional services, that data is almost always flawed, not intentionally, and people are not lying. They're just human. And here's what I see in most firms. Timesheets are batch logged. People work all week, and then they try and remember what they did on a Friday afternoon. They round, they guess, and they log everything to the project they were mostly working on. So your time data is already compromised. Then your GL doesn't line up to your timesheets. Finance records cost in one way, and operations records effort in another. Payroll runs monthly and time is tracked weekly. So the numbers will never fully align. Your cost data and effort data are speaking different languages. Project managers optimize for delivery and not accuracy. If time tracking properly gets in the way of delivering work, accuracy loses. The data is adjusted after the fact to fit what was delivered. Your revenue recognition rules distort reality. Revenue hits 1 month, and costs are spread across several. So 1 month looks great, and 2 look terrible. None of it reflects what's actually happening. And then worst of all, client pressure warps that data even further. Teams log what the client will accept and not what was actually happening. Add it all together and your numbers are not slightly off. They're directionally wrong on the things that really matter. Here's the real problem. You cannot see how wrong the numbers are from looking inside the system. If I was to ask you what your true project costs are this year, you'd give me a confident answer. But that answer is built on misaligned data, rounded estimates, and retroactive adjustments. It feels right because everyone's used to it. Finance expects the variances. PMs expect estimates to be wrong. Teams expect to log time approximately. So it all becomes normal. Until someone from outside the organization comes in and says, why don't these numbers reconcile? That's when you realize you've been making decisions using data that you would never accept from a third party. So, how do you find the truth? When you combine system data with human reality. First, you ingest the data instead of ignoring it. Timesheets, general ledger, project costs. You look for patterns. Which clients always show variances? Which projects always overrun? And which roles never reconcile? These patterns are signals. Secondly, you talk to the people who live in the data. You ask finance why certain variances always exist. You ask your PMs how they estimate their work. And then you ask your teams when and how they log time. Don't get me wrong, these aren't accusations. They're just explanations. Third, you reconcile the numbers against reality. You compare what the system says, what the plan said, and what actually happened. When those don't match, which is invariably the case, then you investigate. That's where the truth lies. And finally, you rebuild the baseline. You adjust for the known noise. You correct for timing distortions. And you stop pretending that precision exists where it never did. Now that you have the numbers, you can actually use. And this is why it matters. When your numbers are unreliable, you make gut decisions. You keep investing in clients you think are profitable. You hire because you feel overloaded. You assume margins are stable because nothing looks broken yet. But underneath, senior people are doing junior work. Capacity is misused and profit is leaking quietly away from the business. These aren't small mistakes. They're the decisions that determine whether your firm scales or stalls. The firms that pull ahead are not guessing. They've done the work to understand what is actually happening. This is why our profit and capacity diagnostic starts with forensics and not reports. In week 1, we ingest your financial, project, and timesheet data. We start identifying where the numbers break. We begin interviews with finance and delivery. In week 2, we reconcile. We isolate the client's projects and the behaviors that distort your view of profitability and capacity. We speak with leadership to understand where the data and reality diverge. By the end of week 2, you know what is actually true in your business. If that clarity isn't worth the investment, then you stop and you pay nothing further. In weeks 3 and 4, we translate that into decisions. We map profit leakage. We assess capacity realistically. We build a 12-month roadmap that reconciles how your business actually operates. This isn't about better charts. It's about better decisions. Look, I spent years at Kantar and WPP, and one thing was always true. The larger the firm, the more system data drifts from reality. Most firms never look underneath. They plan based on inherited assumptions and hope. If you're in Q1 planning, this is the moment to know your real numbers. Not what the system says, but what's actually happening. Our profit and capacity diagnostic is 4 weeks of forensic analysis and structured interviews. By week 2, you know where your profit is made or lost. And by week 4, you know what to do about it. Book a 20-minute profit and capacity briefing. We'll confirm fit and scope. And if it makes sense, and only if it makes sense, we can start quickly. Don't start another planning cycle guessing. Start with clarity that you can act on.